Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. President Trump dispatches top negotiators for additional high-level meetings with both Russia and Ukraine, directing envoy Steve Witkoff to meet Vladimir Putin in Moscow next week. U.S. National Economic Council Director Kevin Hassett emerges as the frontrunner to be the next Fed chair. Traders push the 10-year yield to 4%, betting he will lower rates to where President Trump wants them. Plus, UK Chancellor Rachel Reeves will present her highly anticipated budget today, which will be a test in her ability to please both the bond market and Labour backbenchers. Stay tuned for our special coverage. Well, it's just gone 9 a.m. across the Emirates. I'm Joanna Versace in Dubai. The global rally has continued for the fourth day. So some of those concerns around the AE mega spend, the binge going on there, have been brushed aside. And what we saw is yet another solid day for Wall Street. Also, some weaker data coming through. Retail sales in the U.S. surprising to the downside. Consumer confidence sitting at very low levels. So the soft data, if anything, has been interpreted positively by the market because it just has consolidated the case for that Fed's interest rate cuts come December. The market has sharply pivoted in the last couple of days, as we were talking about yesterday on the show. So S&P futures today leaning more green, up 0.2%. Another story we're watching closely is that Kevin Hassett has emerged as the frontrunner to the Fed, perceived by the market to be dovish. You can see 10-year yields have been moving lower and lower. We did have the bad news, as I mentioned, but then also the perception that Powell will be succeeded by someone vastly more dovish than he is. So 10 years sitting at 4% now. And then European markets, a bit of green on the board. We're keeping a close eye on a couple of things today. Number one, progress with those Ukraine-Russia negotiations, whether we're any closer to a breakthrough. We're going to discuss that on the show. And, of course, that budget, the UK budget that's coming through later today. Brent, you can see just sitting shy of $63. We are actually firmer to the tune of 0.4%, but still sitting at the lowest levels, close to the lowest levels over the past month, on concerns about fundamentals and also this potential breakthrough in Russia-Ukraine. We're going to talk more about that with an expert shortly. Switching over, I did mention it's UK budget day. There is a lot at stake for the UK Chancellor, and no doubt gilt investors are going to be watching it very, very closely. We did see the long end of the UK curve rally back throughout the course of October. We had a softer than expected inflation print come through in the UK, but a mild reversal in the last couple of weeks because the Chancellor seems to have also reversed her plans to raise income tax. And on the back of that, you have seen a backup in yields again. So there are lots of things that the Chancellor is grappling with, in addition to generating that extra fiscal headroom. All of these will put to Lizzie Burden in about half an hour's time for a preview. OK, let's zoom in on how markets in Asia are faring as well. Min Min Lo is in our Hong Kong studio. Min Min.
Hey, Jumana, it's a happy hump day in Asia. As you can see, solid gains across the Asian benchmarks here. As you said, a lot of it because of the macro tailwind out of the U.S. There is the Kevin Hassett factor there and the economic releases boosting bets of a rate cut in December or in January. So that's providing a lift to Asian stocks here. The Kospi up about 2%. But we are watching the currencies in Asia very closely because a few central bank actions to talk about. We have RBNZ cutting rates today, but signaling that they see a small chance of a rate cut next year. And that is boosting bets that the RBNZ could be at the tail end of its easing cycle. And you can see the Kiwi dollar jumping about 1% against the US dollar here. The Aussie dollar also gaining 0.5% against the US dollar after the CPI data coming in hotter than expected. And again, strengthening the case for the RBA to put a pause on the rate cut. But the yen is a different story here because we have a former BOJ official saying that the chances of a rate hike in December is increasing given how weak the yen is. And we are seeing a continued weakness here. Earlier in the morning, though, it was reversing some of the weakness, briefly went below 156, but now back above that level. Yen looking pretty unchanged this morning, but we have, of course, the dollar weakness on the back of the revision of rate cut expectations.
Min Min, thank you so much for the run-through. Min Min Lo in Hong Kong. Well, let's go back to one of our top stories today. President Trump has dispatched top negotiators for additional high-level meetings with both Russia and Ukraine. Trump told reporters he had no deadline for an agreement.
Eventually, that's land that over the next couple of months might be gotten by Russia anyway. So do you want to fight and lose another 50, 60,000 people? or do you want to do something now?
Bloomberg's Greg Sullivan is with us. Greg, so where do things stand right now? Do we have a counter-proposal to the 28-point peace plan that the U.S. submitted to Ukraine?
Well, there's certainly a flurry of diplomatic activity. As you said, Trump is sending his top envoy, Steve Witkoff, to Moscow, as well as Secretary of the Army, Daan Driscoll, to Ukraine. Driscoll was just in Abu Dhabi meeting with the Russians. What we know about the plan is that there was the original 28-point plan, which caused concern among the Europeans and Kyiv. That has apparently been revised. We don't know exactly how. We do know that there are fewer points. There were meetings in Geneva where Trump signaled that the gap with the Ukrainians on this proposal has been narrowed. We've also heard from Russian officials that if it is narrowed too far from original agreements that they had apparently reached in Anchorage, Alaska, that would be unpalatable to them. So right now they're trying to narrow this gap, and Trump is expressing a lot of optimism.
Yeah. How significant was it that U.S. and Russian delegations met in the UAE yesterday, according to media reports, and then also other reports suggesting that Ukraine's military intelligence chief was also in Abu Dhabi as well?
Yes. So in terms of the Russian meeting, it is significant because it shows that the U.S. and the Russians are maintaining contact amid all this ongoing negotiations. It was unclear that would happen, especially after the Budapest summit fell through.
Yeah.
It was unclear where those channels stood, but they are apparently working. Talks are happening, and obviously we have Witkoff now going back to Moscow. So that in itself is significant.
Well, one of the biggest pushbacks, and we discussed that original 28-point plan proposal, was the lack of clarity around the security guarantees. Could we end up in a situation where Ukraine actually accepts to give up land in exchange for stronger guarantees?
This is actually the crux of the issue.
Yeah.
It's really hard to see what will satisfy Ukraine that will not be a deal breaker for Russia, and vice versa. And as you said, it comes down to two huge things: land, territory that Moscow does not control right now, hasn't been able to take militarily, that they're demanding Ukraine cede to them, as well as security guarantees. Ukraine needs to know that Russia can't restart the conflict down the road, but Russia's demanding that no NATO forces be stationed there and that there are curbs on Ukraine's military. So it's hard to see how this is bridged, how they come to compromise on this, and that is probably what the flurry of diplomacy happening right now is all about.
Yeah. Greg, thank you so much. It's certainly been an escalation in tempo, though, in the last couple of days. Greg Sullivan. Well, oil has steadied after closing at a one-month low on signs of this Ukrainian peace deal getting closer. Joining us now is Daan Struyven, Goldman Sachs co-head of Global Commodities Research and head of oil research. Really good to have you with us here in the Middle East. Daan, actually, let me just start off by asking you about the latest, with Ukraine, Russia, and how much downside risk you think that could pose if we do get a breakthrough in the coming weeks.
Great. So our base case is a status quo from a sanctions perspective. And under our base case, where you have a status quo, Russian oil production continues its downward trend. In our base case, oil prices next year for Brent will average $56 per barrel, so roughly 10% of downside.
Yeah.
However, if we were to see a peace deal, a potential lifting in U.S. sanctions, we estimate roughly $5 per barrel of downside. So we're already below the forwards forecast. So that would put Brent in 2026 probably in the low 50s. Downside because Russian production may not decline. And second, we have seen very significant increases in Russian oil on water. That may normalize, that may moderate more inventories on land. And so an additional source of potential downside pressure on crude prices.
Okay, so let's go back to your forecast for next year. You are forecasting Brent and WTI to average, respectively, over the course of 2026, $56 and $52. Those both below the forwards. What is the rationale here? Is it simply just a mismatch between supply and demand?
Exactly.
Yeah.
So
how much oversupply do you see?
So we think that next year the global oil market will be in a surplus of 2 million barrels per day, 2 million barrels per day more supply than demand. The main reason for that forecast is that we think the oil market is right now already in a surplus. If you just add up all the oil inventory barrels that we can track across the world, we have been close to building by nearly 2 million barrels per day already over the last 3 months. So we're not calling for a sequential easing in the surplus. We're basically calling for a status quo, a continuation of the very supply-driven strength we're seeing.
So you see a surplus of around 2 million already in this market? right now?
If you just look at the last 90 days, and if you
Yeah.
just add up all the inventories that are building, you're close to 2 million barrels per day, with most of the increases on water, though. And to see the next leg lower in oil prices, I think a greater share of those builds need to happen in the pricing centers on land. And one reason why oil and water has built so much is pressure from sanctions, especially from Russia, but also Iran, for instance.
China's stockpiling has been a big theme throughout the course of this year, and I think that took people by surprise. Is that no longer a tailwind going into 2026?
So we saw a very rapid pace of stockpiling over the summer. We have seen a moderation over the last few months. I think it's partly seasonal. We assume an additional acceleration in Chinese stockpiling. We assume Chinese inventories will rise by about 400 KBD in 2026. That's absorbing about 20% of the global builds that we expect. We think it makes sense to look for an acceleration because China's stockpiling tends to be price sensitive, and we forecast lower prices. Second, because Beijing is focused on energy security. And third, China has a lot of room to store extra oil.
Okay, so one thing that I've noticed about your forecast is you're short-term quite bearish, but then more medium-term, you're forecasting $80 Brent from late 2028. Why are you seeing the uptick in a couple of years' time?
Yeah, so the short story is that in 25 and 26, we think we're going through a big supply wave. But later this decade, we see just much fewer supply growth projects at the horizon. We expect oil demand to grow through 2040. And so it's this combination of strong above consensus demand growth and a moderation in what has been exceptionally strong supply growth that leads us to forecast that oil prices will need to rise to incentivize investment. We have seen relatively low investment in oil projects over the last 15 years. And I think if we had not seen the amazing U.S. shale productivity boom, oil prices would have been significantly higher.
Yeah, what do you see happening with U.S. shale production in light of that? Because you mentioned that as prices continue to drift lower, we're probably going to see less of an incentive to continue with the pace of supply growth that we've had the last year or so. How does that affect U.S. production outlook in the coming years?
Yeah, so our base case is that the oil market is in a large surplus in 26, but then rebalances in 27 because low prices are expected to take their toll on non-OPEC supply in 27, especially in the U.S., where total liquids production has been up an unbelievable 1 million barrels per day year over year, despite low and falling prices. We expect roughly flat U.S. shale supply under our forecast, where prices come down further, and that will help to rebalance the market in our base case.
Yeah. Okay. Another commodity we've been watching super closely is gold. Obviously, with everything that's happened this year, it's had a stunning 2025.
Yes.
Do you expect that to be replicated in 2026? Are you still bullish gold here?
Yes. We look for nearly 20% of additional price upside by the end of 26, with our forecast at $4,900 per troy ounce by the end of 26. Not as fast as this year. We're up almost 60% year to date. But the two drivers of the 25 rally, we think will be repeated in 26. Number one, structurally higher central bank purchases. Since the freezing of Russia's central bank reserves in 2022, EM reserve managers got this big wake-up call that they need to diversify into gold, which is the only truly safe asset once you hold it in your domestic vaults. And second, Fed cuts. Fed cuts, because gold is a non-yielding asset, tend to attract inflows into the gold ETF market. And with our economists' forecast that you see 75 basis points more of Fed cuts, we get support both from central bank buying and from private investors.
It wasn't that long ago that people were talking about the great debasement trade that was going through, that investors were reallocating away from the USD into other safe havens. A lot of that money found its way to gold. The dollar has been supported in the last month. It's actually regaining ground again. How does that impact that thesis, that part of the market?
So I would think of a potential broadening in this diversification theme, which currently is quite restricted to central banks. But if that were to broaden to private sector investors, it would cause further upside to already bullish gold price forecast. I think the key intuition for the size of this price upside from private sector diversification is that the gold market is relatively small. If you look at global gold ETFs, they are about 70 times smaller than the value of the U.S. Treasury market. So you only need a relatively small diversification step out of, for instance, global bond markets to cause significant upside to the gold price. So It's another reason why gold is our favorite long commodity recommendation. You have significant upside in the base case. And in scenarios where markets may perform less well, perhaps concerns about the fiscal trajectory or questions about Fed independence, I think gold would do even better than in the already attractive base case.
Daan, so good to chat to you. Thank you so much for coming in. Daan Struyven, Goldman Sachs co-head of Global Commodities Research and head of oil research. Well, still ahead, we speak to HSBC's Simon Williams about the economic picture in the MENA region. But first, the next Fed chair. As a frontrunner for the top job emerges, we discuss the implications of a Trump-aligned institution. That's next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersechi in Dubai. Bloomberg has learned that White House National Economic Council Director Kevin Hassett is seen by advisors and allies of President Trump as the frontrunner to be the next Fed chair. Hassett told Fox News he is prepared to serve.
If he were to ask me to be Fed chair, then of course I would have to say yes, because I want to serve my country and I want to serve my president. But we'll see how it goes. There are a lot of great candidates.
For more, our managing editor Jill Deeses joins us now from Hong Kong. Jill, what do we know about Kevin Hassett?
Well, look, I think the bottom line here, Jumana, is that if Trump is looking for somebody that is going to attempt to carry out his policy priorities while as the chairman of the Federal Reserve, Kevin Hassett really seems to fit the bill. I mean, so far, we've really seen, particularly over the last year, Trump really heavily criticized Jay Powell for not cutting interest rates aggressively enough. That's something that Kevin Hassett has said that he would do. If you count television interviews as part of the interview process for becoming the Fed chair, which I think, Trump kind of has a tendency to do. We've heard Kevin Hassett say on Fox News elsewhere, he would be cutting interest rates right now based on the data available to him. So he doesn't really think the Fed is moving fast enough right now. We've also seen Hassett criticize the Fed for allowing inflation to get out of control in the wake of the pandemic. So, I mean, really, these are all kinds of things that really fall in line with what Trump is ultimately looking for. He's obviously been incredibly disappointed with Powell in that position. So I think at this point, that does seem to be according to what we're hearing, the front runner. There's still some other candidates that are in the race for this, but we'll have to see. But it does seem that Kevin Hassett, at least, is right now sort of leading the pack.
Yeah, so when do we expect to hear results? How far along the process are we? You mentioned that there are some other candidates still in the race at this point.
Yes, that's right, Jumana. So at this point, what we've heard from Scott Bessent, Treasury Secretary, who's actually leading the search, is that we could get something before the end of the year, possibly before Christmas in terms of an announcement. Obviously, we're still expecting Jay Powell to serve out the remainder of his term through the first part of next year before the replacement would ultimately come in. But yes, there are still some others in the race. You're seeing those on your screen right now. That includes Christopher Waller, who's currently on the Fed, as well as Michelle Bowman. Kevin Warsh, a former Fed official, is also there. So you do see some other contenders here. As we understand it, they're sort of finishing up some levels of interviews this week, and then we'll have to see where we ultimately go. But yeah, it could be that we get some kind of an announcement from the Trump administration before Christmas.
Yeah. What do you make of the market reaction? This morning, I noted that 10-year Treasury yields were drifting lower, closer to 4%. Is it a case of the market actually repricing, the yield curve repricing in anticipation of a very dovish successor to Powell?
I mean, possibly, Jumana. I think that at this point, the language that you've really heard from Hassett is that idea that he would like to cut interest rates more aggressively. Obviously, the Fed chair alone is not the only one that ultimately makes that decision. And I do think that one thing that the market should probably keep in mind is that, once somebody is actually in the position, sort of, what ultimately happens from there might not necessarily be in 100% lockstep with what Trump is looking for. And again, we don't really know who exactly could be the Fed chair, because Trump is also known for some surprise decisions. So even if Hassett is the front runner right now, it's really not over until Trump actually makes his announcement. But yes, ultimately, I think, at this point, Trump has really indicated that he wants somebody there that is going to really sort of aggressively push for lower interest rates. Once again, that's something that he's been really upset with the Fed at this point in not executing on. So I would imagine that anyone that sort of steps into that position, you'd imagine that Trump has taken a really long, hard look on how much he believes that person is going to be in lockstep with what the President of the United States ultimately wants.
Bloomberg's managing editor Jill D sits in Hong Kong. Thank you so much. Well, coming up, UK Chancellor of the Exchequer, Rachel Reeves, is set to release her second budget later today. We discuss the tightrope she's walking a bit later in the show. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Johanna Versace in Dubai. President Trump says Beijing has more or less agreed to pick up the pace and size of its U.S. agricultural purchases. Trump told reporters aboard Air Force One that Chinese President Xi Jinping will surprise to the upside when it comes to trade. Trump and Xi held an hour-long phone call on Monday to discuss trade and the tensions between China and Japan over Taiwan. BlackRock plans to rapidly double or triple its current investment of over $35 billion in Saudi Arabia and the broader Middle East. The world's largest asset manager sees the strongest growth opportunities in infrastructure as the kingdom develops its non-oil economy. BlackRock and other Wall Street firms are essential to Saudi Arabia, providing capital for its growing economic diversification projects. And Saudi Arabia has started work on new alcohol stores in Jeddah and Dammam for some non-Muslim customers. The moves indicate the government is quietly widening access to alcohol for a larger group of foreign residents beyond just diplomats who hold special permits. This gradual relaxation of restrictions is part of the kingdom's broader Vision 2030 efforts to attract foreign talent and diversify its oil-dependent economy. And a look at markets as we head into the break. Everything is pointing green. S&P futures up 0.3%. And what a rally for European markets, up 0.7%, keeping a close eye on those Ukraine-Russia negotiations. Up next, we speak to HSBC's Simon Williams about the economic picture in the MENA region. This is Bloomberg. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. President Trump dispatches top negotiators for additional high-level meetings with both Russia and Ukraine, directing envoy Steve Witkoff to meet Vladimir Putin in Moscow next week. U.S. National Economic Council Director Kevin Hassett emerges as the frontrunner to be the next Fed chair. Traders push the 10-year yield to 4%, betting he'll lower rates to where President Trump wants them. Plus, UK Chancellor Rachel Reeves will present her highly anticipated budget today, which will be a test in her ability to please both the bond market and Labour backbenchers. Stay tuned for our special coverage. It's 9:30 a.m. across the Emirates. I'm Johanna Versace in Dubai, getting you up to speed on these markets. The global rally is continuing for the fourth day. Green on the screen everywhere. S&P futures up 0.3%, brushing aside some of those AI bubble concerns. Also brushing aside the weaker data that came through yesterday from the U.S., both retail sales and consumer confidence showing dim figures. But on the flip side, you could say perhaps it actually consolidates the case for an interest rate cut come December, which is where the market is sitting at right now. A 10-year yield sitting at 4%, so we've rallied a couple of basis points throughout the course of the last couple of days. A lot of attention on who the next Fed chair is going to be. It looks like Kevin Hassett is emerging as the front runner now, known to be quite a dovish voice and closely aligned to President Trump. So the interpretation is quite dovish from a yield investor perspective, bond investor perspective. European markets, take a look, though, at the price action there, up 0.7% in early trading. No doubt some of the positive signals coming through on Ukraine, Russia are helping that market. And then Brent, you can see, is slightly firmer, up 0.3%, but still just below $63. $62.70 is where we're at, and close to 1-month lows again on this potential overhang of supply. We were just speaking about it with the global co-head of commodities from Goldman Sachs, and he's saying they already see around 2 million barrels per day of extra supply in this market, plus that potential breakthrough on Russia-Ukraine, what that could mean for a resumption of Russia supplies more broadly to the market. So that's what's been going on in oil space, but it is a huge day in the UK. Let's just switch over and show you what is at risk for the Chancellor. We're going to be speaking to Lizzie Burden in just a few moments. But ultimately, the real test of whether this budget is going to be successful for the market is the reaction in gilt yields. And so far, for most of this year, we've seen the UK long end under a lot of pressure. It reversed a little bit in October with a softer CPI print. But again, the last couple of weeks, we've backed up again on the Chancellor U-turning on the decision to perhaps raise income tax. So that's no longer happening. The question is, where is this fiscal consolidation going to come from? That needs to be answered later today. OK, let's also zoom in on how markets in Asia are faring. Min Min Lo is in our Hong Kong studio. Min Min.
Hey, Jumana. Yes, Asia markets broadly on the upside today, as you said, because of the macro tailwinds out of the U.S. But we're watching some sectors. And here I have Alibaba on the board because it reported earnings after market close yesterday. And yes, revenue was a beat, both for the overall revenue. E-commerce was 16% higher and cloud was 34% higher. Big beat there. But the bottom line, the net income saw a big slump, and that's because of the price competition with the likes of JD.com and Meituan, and investors punishing the stock here, down 0.9% or so. But Meituan, the rival, up by 6%. This is the top gainer on the HSI today, and we are looking ahead to its earnings call on Friday. Now, we are expecting losses there, but the reason why we are seeing big gains here, our analysts say, is because there has been many traders shorting the stock, and they're now covering it just ahead of earnings. Could be because Alibaba did mention their investment into instant retail has peaked in the last quarter, and that means if the price competition subsides, it could lift all boats in the sector. But flip the board, we're also watching SoftBank, a very volatile stock. If you remember, yesterday was a 10% slide. It's been sliding for the last couple of sessions, but now gaining by 6% after the information reported that OpenAI expects to see over 200 million paid subscribers by 2030. And of course, SoftBank heavily exposed to OpenAI. Not enough to recover the losses that we saw yesterday, but still decent gains to the upside here.
That is interesting. Increased number of paying subscribers to ChatGPT. Min Min Lo in Hong Kong, thank you so much. Well, HSBC sees robust activity remaining in the GCC project market, led by real estate. But Simon Williams, the bank's chief economist for Central and Eastern Europe, Middle East and Africa, sees signs that the cycle is starting to mature. Simon joins me now in the studio. Really interesting research note that you put out on the GCC project market, and just bringing out a couple of numbers that stood out to me. The value of schemes in the execution phase is around $2.1 trillion. You're saying that that's a record high, equivalent to 90% of GCC's GDP. I mean, to me, it really still speaks to a region that is growing.
Yeah, even
quickly.
Even the GCC, $2.1 trillion, that's real money, and there is momentum running through this capital spending cycle. It's been building really since the end of COVID. And what's striking for us is the contrast between the capital aspirations here and the more downbeat investment plans that there are elsewhere in the world, whether that's in developed markets or in emerging markets. But also that sense, yes, that after a very strong 4 or 5 years, the spending cycle isn't slowing, but I think it is maturing. CapEx is still up, but perhaps not up by quite as much as it was in previous years.
And what are the signs that it's maturing? Is it just simply that we're growing, but at a slower pace than we were before?
Yeah, there's an element of law of big numbers here. As a pie gets bigger, it's harder. You don't get the expansion at the same kind of pace. But again, there was that really big rebound post-COVID, which is still there. The numbers still show me momentum, but perhaps a little less than there was before, and also a real divergence between different parts of the region as well.
Yeah, we'll get there, but let me just ask you, what are the main sectors that are exhibiting this growth?
A lot of it is still orientated towards real estate, building out of residential space, of office space, or its health space as well. But I'm also seeing more money going towards infrastructure, more money going to the power sector as well, and a real focus on renewable energy in some parts of the region too.
I was going to say, what about digital infrastructure? Are you seeing more growth in that in the last couple of years?
It's certainly there in the aspirations, and we're a bit behind the cycle here in the Gulf compared to some other parts of the world. But no, any policy announcement you listen to from pretty much any big policymaker anywhere in the regions are all focused around that build out in digital capacity.
So I think people will have a lot of questions specifically about the Kingdom of Saudi Arabia, given we talk so much macro about the reprioritization, the recalibration of projects that are underway. According to your research, the value of new contracts signed is down by almost a third in rolling 12 months terms. So is this just a direct reaction to what they're trying to do at a macro budget level?
Yeah, we've been hearing about that discussion for a long time, been waiting to see it in the data. I'm beginning to see that softening, not in the amount of work which is actually underway, the level of execution in Saudi. The capital project has been rolled out. Now, they're still worth a huge amount of money, but I'm looking for momentum. What I'm really tracking is the pace at which new contracts are being signed. And yes, the data we see does suggest that finally that new contract work is beginning to slow.
Yeah, and what impact do you see, and this is unrelated to your report, but ultimately, how do you see that affecting the public finances that we spend a lot of time scrutinizing?
I guess there's two bits to it. In terms of the levels of GDP growth that we're expecting, I'm not making any changes to my forecast. I'm still looking for a non-oil economy growing around sort of 4% this year, next year, and in 2027 as well. And capital spending is clearly a big part of that. My forecast for Saudi public finances, I'm running with an oil price of $65 a barrel for next year and 2027. Some pick up in production, which gives revenues a bit of a lift. A deficit comes through. That's sort of 4% of GDP, so maybe a little higher this year, maybe a little lower next year. That's a significant sum, but there's a sum that a country as wealthy as Saudi can carry.
Yeah, I guess it's interesting because even though the pace of new projects has started to slow down and there has been this recalibration, why are we not seeing more of an impact on Saudi Arabia's growth trajectory?
I think there's always a limit to Saudi Arabia's absorptive capacity. There's only so much new capital you can put to work at any one time. And perhaps I've just been a little more cautious than some on the pace at which that investment spending was likely to be rolled out. But the pickup in capex, the percentage of GDP, that's very clearly there. I think Saudi is operating at potential.
Yeah, OK. One other thing that stood out to me from your report, Qatar has regained some momentum, but more than half of the project work is concentrated in the oil and gas sector. So it does not speak to a country that's investing a lot in diversification or as much as the other countries.
There is definitely a split across the GCC region. A little bit of a slowdown in new contract work in Saudi Arabia. UAE, now that project market is still growing very, very quickly. Other parts of the region, for sure, there is more modest increases in capital spending. That's definitely the case in Qatar. We're off the lows, but we all know about the big increase in capital formation there was ahead of the World Cup. And since then, we had expected to see new investment in the non-oil sector slow, and that's what the data is showing us.
Yeah. Simon, always good to chat to you. Thank you so much for coming on. Simon Williams, HSBC Chief Economist for Central and Eastern Europe, Middle East and Africa. The UK Chancellor Rachel Reeves faces a big test when she delivers her second budget in the House of Commons later today. It has been drafted with bond market investors and Labour Party backbenchers in mind, she says. So for more, let's talk to Bloomberg's Lizzie Burden. Lizzie, earlier, a couple of minutes ago, I was just talking about the price action going on in long-end gilt yields. Clearly, everyone is watching this budget very, very closely. But how much of a bind is the Chancellor actually in to satisfy all stakeholders?
Absolutely, Jemana. We've had months of speculation, weeks of leaks. Finally, we're here. But as you say, the Chancellor really caught between the bond vigilantes and the left wing of her party. Now, the independent fiscal watchdog, the Office for Budget Responsibility, is expected to say that UK borrowing will be £20 billion higher per year by the end of the decade than it had expected in March. And for that reason, she'll have to rebuild the public finances because that £10 billion or so of headroom against her fiscal rules that she left in the spring appears to have been wiped out. So at first it seemed like she was going to rebuild it by breaking Labour's manifesto, raising income tax, but then there's been a policy U-turn and we've had officials rolling the pitch for a smorgasbord of smaller tax rises. So now we ask, how much headroom is she going to leave? £15 billion is the expected figure, but the market would like more. Still, though, even that is going to be politically painful. Never before has Labour polled worse than it is at the moment. And so the bar for success is incredibly low here for Rachel Reeves. If she can avoid a gilt market sell-off, Jemana, if she can even just stay in a job, maybe that's what she's got to be happy with.
Stakes very high. Well, you talk about weeks of leaks, Lizzie, which is true. Lots of things being leaked out to the media and then some of them rescinded. What do we know about some of the individual measures we can expect today?
Yeah, and including to our own reporters here at Bloomberg, the biggest measure on the tax side appears to be a stealth tax rise and freeze of the personal tax thresholds. but also perhaps a mansion tax on homes over £2 million. That would have a strong political message, but it's not expected to raise as much revenue as expected. Then on the spending side of the ledger, a big question about how much Chancellor Rachel Reeves is actually going to cut spending, or how much she'll just leave it to tax rises to raise revenue and keep herself in this doom loop of having to come back and back and back for tax rises. It looks like she could lift the two-child cap on benefits at a cost of £3 billion. And then there's the question of, if she backloads spending cuts to the end of the decade, how much credibility that would have in markets on the debt sustainability front. So, of course, we keep an eye, as you say, Jemana, on gilt yields, the reaction to this. Of course, the spectre of Liz Truss looms large over Rachel Reeves here. And, of course, we mind sterling as well. You've seen a huge amount of volatility on the pound-euro trade, and you've seen traders piling into bets that the pound is going to be weaker against the dollar as a result of this budget. If the Chancellor can dance on this pinhead successfully, if she can balance the books here, actually, you might see a relief for sterling.
And there's one potential curveball, and market participants are eagerly watching this as well. And it's nothing to do with the Chancellor. It's the OBR's estimates of long-term productivity. How will that also be factored in, do you think, into some of those long-term forecasts? And how much of a swing factor could it actually be in determining the market reaction to the budget today?
Well, of course, this is a huge part of the messaging that the Chancellor has been putting out there, of the reasoning for why she's had to make the difficult decisions that she's going to have to make today. She's already been trying to blame the Conservatives for this, blaming Brexit, blaming austerity, blaming the pandemic. If you look at the productivity forecast, that is going to factor into that £20 billion that I mentioned, Jemana, that higher borrowing cost. It's also, though, down to higher borrowing costs and U-turns from the Chancellor herself. So it factors into this difficult outlook in the long term, even if maybe in the shorter term things could look a little rosier.
Lizzie Burden in London in the studio for now, but going down to Westminster, Abingdon Green, looking forward to your coverage later on throughout the day. Well, UK Chancellor Rachel Reeves will be delivering her budget at 12:30 p.m. today in London. That's London time. Viewers in the UK and Europe can join us for full coverage and analysis as it happens. And coming up, Tesla's electronic door handles, which are widely copied across the industry, are now raising serious safety concerns. Our big take next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Some auto industry analysts have told Bloomberg that electronic door handles are proving to be a safety hazard, leading in some cases to deadly outcomes. The feature, pioneered by Tesla, has been adopted by many other automakers as well. And some are now redesigning their electronic devices so they can be manually operated after a crash or fire. For more on today's Big Take, let's bring in Linda Liu. These electronic door handles were supposedly a snazzy feature in some of these EVs, launched originally by Tesla. And of course, many other EV makers took on the same technology design as well. But it seems as though they've also created problems. So how widespread are these problems?
You're right, Jomana. Our colleagues who came up with this really timely reporting show that last year, in 2024, the number of complaints really jumped by something around 65%, showing that consumers are finding these electrically operated door handles are becoming probably harder and harder to use. And in the US car market right now, about 70 models out there actually feature these kind of electrically designs. And that just really shows how many cars out there that will have potential problems, when it comes to accidents where the vehicles lose power. And Tesla may be the car maker that really popularized the design, but these complaints have spanned more than a dozen brands, not just EV brands, but you've also got legacy brands such as Volkswagen, Ford, or Lexus. So this problem has really become industry-wide.
And what are the automakers actually doing to address these concerns? Are they doing away with the electric handles, or are they making some modifications?
Yeah, so Tesla has said they are looking at redesigning the door handles, probably featuring some kind of over-the-air update to how these door handles will be operated in the case of emergencies. But you've also got other safety advocates that suggest door handles that feature some components of mechanical release as well as electrically operated seems to be the way to go, as they kind of contain the best of both worlds. Really, there's a whole range of options out there that automakers are considering. But for a product such as cars, they take many years to design, develop, and really put into production. So a lot of these designs may bring additional costs as well as time in the whole process of bringing these cars to market. So I think the automakers kind of really have to think about how the design for future vehicles is going to look like.
Bloomberg's Linda Liu, thank you so much for bringing us today's Big Take. And you can read this story and all of our previous Big Takes on the terminal. Just type NI Big Take Go and on Bloomberg.com. And coming up, Nigeria's central bank pressed pause on rate cuts, a surprise move that defied expectations. We'll have that story next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Nigeria's central bank held interest rates steady to maintain downward pressure on inflation. The Monetary Policy Committee kept the benchmark rate at 27%, despite widespread expectations for a cut. For more, Bloomberg's Ondiro Ganga joins us now. Ondiro, given the surprise hold, what more do we know about the MPC's more hawkish stance?
Good morning, Jumana. So what we are seeing is the central bank is putting caution ahead of optimism. What Governor Cardoso wants to do is he wants to sustain the progress and ensure that inflation continues falling. And he acknowledges a couple of things. One, he acknowledges that there are good capital inflows, the currency is stable. The tight monetary policy stance that has been maintained by the central bank has done a good job in bringing inflation down. Last year, they were looking at inflation at a high of over 30%. In the last month, inflation has just gone from 18% to 16.1%. And even though we are seeing that downward trajectory, members of the Monetary Policy Committee still feel like 16% is double digit, is high, is outside the central bank target range, and that's why they chose to hold. And this is in contrast to what the market was anticipating. All the economists that were surveyed by Bloomberg were expecting either 50 basis points cut or 100 basis points cut, because again, inflation has shown that it is going down. But on the other hand, Standard Bank was saying, the central bank might want to take a measured approach towards the end of the year. There's a lot of dollar demand from corporates. There's also a lot of consumer demand heading into dirty December, and they don't want to derail all the efforts they have put in. So all eyes now go to February 2026 when the central bank will be sitting again. And then Bloomberg economist Yvonne Mhango is confident that we are likely to see a cut because they would have had enough data to signal that they have firmly anchored inflation and it will continue going down.
But at the same time, you have to think of it within the context of the region. And even though Nigeria is standing pat, other central banks have been embarking on a rate-cutting cycle. Can we expect more of the same in 2026?
Absolutely, because these cuts are based on what the markets is showing. And if we look at the international markets, for example, the U.S., the dollar has shown signs of weaknesses due to trade wars and tariff wars that is going on between the U.S. and other economies. Then you have softer signals from the Federal Reserve, coupled with falling oil prices. If you go back to the continent and zoom in, you see that inflation is going down after the central banks had maintained a really tight monetary policy stance. And now they have the room to begin cutting. And we've seen this happening in different markets. You look at DRC, you look at Zambia, they cut rates for the first time. Other countries, for example, Ghana today, we're expecting a rate cut of 350 basis points. And this is such a big cut. Last time they also cut by the same amount. And it's for a couple of reasons. Inflation is the lowest it has been in 4 years, from peaking at a high of 54%. They've also gotten great windfalls from gold, from cocoa. Their currency has gained 30% against the dollar. So the Central Bank of Ghana has the confidence in the room to continue the easing cycle and aggressive easing at that. We also saw South Africa cut rates. We're expecting a rate cut from Angola. And all this just signals that the continent is at a place where they feel confident. But then again, the monetary policy that central banks are putting in has to be supplemented by fiscal policy reforms from the government for this to actually spur economic growth in the region.
Andira Ganga in Kigali, Rwanda, thank you so much. And let's round up the show, taking a look at the equity futures. Things are pointed up. U.S. futures up 0.4%, brushing off some of those concerns that we spoke about yesterday. European markets up a solid amount, 0.7% firmer. Keeping a close eye on the U.K. budget today, in addition to those discussions that are taking place between the U.S., Ukraine, and Russia for a potential breakthrough. That is it for our show, Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai.